All right, let's talk about something that has completely changed the game in finance: black box trading. We're going to crack open that box and see what makes these systems tick. Because, believe it or not, they're the ones dominating the world's financial markets right now. So, to really get this, we're going to start with a mystery, a really weird one that happened back in August 2007. And get this, it was a full year before the big financial crisis that everyone remembers. So, what if the market had a massive crash and nobody even noticed? I want you to picture this. You look at the S&P 500, the big market indicator, and it's totally flat. Looks like a boring day, right? But underneath that calm surface, it's absolute chaos. The whole system is basically ripping itself apart, and the one thing everyone looks at says, nope, nothing to see here. Well, that's exactly what happened. On this one day, August 6th, you had entire sectors just going nuts. Mining stocks shoot up 18%. Manufacturing stocks plummet 14%. That's a massive 32% swing between the winners and the losers. But, and this is the crazy part, because they moved in opposite directions, they just canceled each other out. The big index, the S&P 500, didn't move an inch. You can imagine the human traders just scratching their heads, completely baffled. Yeah, there's actually a technical term for this. It's called dispersion. And all that really means is that the gap between the best and worst stocks just exploded. It was totally unprecedented. I mean, think about it. It was like a massive financial earthquake was happening, but the Richter scale everyone was glued to just wasn't moving. Okay, so a few weeks go by, and then we get our first real clue. Suddenly, this super secretive, super successful group of hedge funds, they're known as the Quants, they all report these catastrophic losses. And we're talking about the smartest guys in the room, right? The rocket scientists of Wall Street. And somehow their genius computer models all blew up on the very same day. What are the odds? And this is the absolute key takeaway. This wasn't people in trading jackets panicking and screaming on the floor. No way. This was a silent, invisible panic happening inside computer servers. It was the first big warning shot, the canary in the coal mine, that a totally new and kind of scary force was now running the show. So that begs the question, right? What are these machines? What's going on inside these so-called black boxes? Well, let's pry one open and take a look. At its core, black box trading is all about using really complex math formulas to find little patterns or, weird anomalies in the market. It's basically about finding those tiny, fleeting glitches in the matrix. And the key is, a computer does all the work automatically in the blink of an eye. Okay, so here's a classic example of what these things do. It's called statistical arbitrage. Think about two stocks that are almost always in sync, like Coke and Pepsi. Their prices usually move together, right? Well, the black box is constantly watching, and the second their prices drift apart more than usual, bam, the machine jumps in. It'll automatically sell the one that's too high and buy the one that's too low, betting that they'll snap back together. And when they do, it closes the trade for a tiny profit. Now, do that millions of times a day across thousands of stocks, and those tiny profits add up to, well, billions. Which brings us back to our mystery. Why did they all fail at the same time? I mean, these are supposed to be hyper-intelligent competing systems, right? How in the world could they all lose big time on the exact same day? The answer is kind of simple and kind of terrifying, because even though their formulas were secret, they were all listening for the same whispers. They were all chasing the same signals. Yeah. Just think about it like this. All these machines are trained to hunt for those price anomalies, those little market glitches. They're looking for the same kinds of things. So even if each fund has its own secret sauce, they're all shopping for ingredients in the same aisle. So here's what probably happened back in August 2007. One really big quant fund had to suddenly sell off a massive chunk of its portfolio, maybe to cover losses somewhere else. This giant, unexpected sale completely messes up the normal market signals. Things like volatility, volume, the gap between buy and sell prices. It's like throwing a huge boulder into a perfectly still pond. What happens next? Well, all the other black boxes, they see those massive ripples, but they don't see a boulder. They see a new, powerful trading pattern, and so they all jump in at once, trying to ride the wave, and in doing so, they turn a ripple into a tidal wave. They amplify the chaos. So you gotta be wondering, how did these machines get so powerful so fast? This wasn't some slow, gradual evolution. Nope, it was more like a hostile takeover, and it was fueled by some really important changes in both technology and the rules of the game.
You can trace it all back to a storm of changes in the late 90s. First, you get standardized digital languages for trading, so all the computers can speak to each other. Then you get these new electronic exchanges, and then the regulators basically level the playing field, letting these new exchanges compete with the old guard. The final piece of the puzzle? Interfaces that let the hedge funds plug their computers directly into the market. Suddenly, you didn't need a human broker anymore. The machines could now talk directly to other machines. And just like that, the age of automated trading was born.
And to really grasp just how huge this change was, let me tell you about a legend called the Docomo Man. This guy in Japan found a weird quirk in the Tokyo Stock Exchange. There was this big, clunky minimum price step for a single stock, NTT Docomo, and he figured out how to manually exploit it over and over and made millions. But then, in 2008, the exchange just changed the rule, and poof, his entire strategy vanished overnight. Now, think about what the black boxes do. They're essentially doing the exact same thing as the Docomo Man, but they're doing it for microscopic profits across thousands of different stocks, millions of times a day. There's just no way any human can possibly compete with that. So, you see, this isn't just about a new type of trader showing up. This has fundamentally rewired the entire stock market. It's like a whole new ecosystem has sprung up with totally different rules and, frankly, totally different predators. You know, the old world of investing, the one you see in the movies with guys meeting CEOs and reading annual reports, that was all about human judgment. It was about figuring out a company's value over months or years. But this new world, it's completely different. It's dominated by machines making split-second statistical bets on market behavior. You could say the old way was about economics, the new way is about pure physics. And if you're thinking, okay, but why does this matter to me? Well, here's why. Right now, these quant funds, these black boxes, they account for more than a third of all stock market trading. A third. That means their lightning-fast decisions are having a massive influence on the price of literally everything. Your pension fund, your 401k, the stocks of the biggest companies in the world, they're all being shaped by these algorithms, whether we realize it or not. So that leaves us with a really big, kind of unsettling question. In a market that's now dominated by machines, all chasing the same kinds of signals, who's actually in control? As these systems get faster and more complex, and they trade more with each other than they do with any of us, are we actually building a smarter, more efficient market? Or are we accidentally building a much more fragile one that's just waiting for the next phantom crash that no one sees coming until it's already too late?